Tuesday's class. I did record. I haven't posted the recording yet, but I will post those to Canvas, so you can start looking for those in the next couple of days or so. You don't have to rewatch the lecture, obviously, if you're here. And there's an expectation, by the way, that you are here. Folks that, because I'm showing 30-something students are here, and I think there's something like about 34 students are here. I think 33, because I'm logged in as a student as well. So 33 students are here, and there's 40 people registered in the class. So I will be dropping those individuals that don't show up. Okay, so make sure you're here in class. It's a synchronous meeting. Even though it's online, there's an expectation that you're, adhering to the college's attendance policies. Okay, good. So with all that, let me go ahead and, there's no other questions, put up our slides for today. And I am hoping that my camera will keep in good operation as I go to tablet. I just like to mess with me when I do that, but it looks like we're okay. And I am going to go into slideshow mode. Okay. All right, good. So let's go ahead and just review some of the key things that we had talked about last time. So remember, we said that in this class, we're focusing on financial reports that are prepared for external audiences. And we said that our primary external users, are investors and creditors. Now, there are other external users that we might have some concern about, but they're not considered our primary users. For example, customers to a company would be external users. Maybe you're going to have some sort of installation done in your home. There's a warranty that goes along with that. It's a large investment like solar panels or something, and you want to make sure that that company is going to be in business to service those solar panels, to live up to their warranties and not. So you may be interested in the financial statements of the company as an external user from that standpoint, but though you would not be considered a primary user. So we have primary users, and we said that we have the Security Exchange Commission that was created through Sarbanes-Oxley, and the Security Exchange Commission is responsible. It wasn't created through Sarbanes-Oxley. It was created through the 1933-34 securities laws, and the Security Exchange Commission was. And the SEC has the authority to set accounting standards for public companies. So public companies have to prepare their financial statements, and the SEC is the entity that is responsible for making sure that they do that, and that they're the ones that issue the accounting standards. But back in 1939, the SEC turned to the Financial Accounting Standards Board and said, you profession, you should be the ones that will set the standards. And so the FASB, it's a 7-member board, prepares the standards that companies are to use when they prepare their financial statements. So if I'm, say, Apple, I have to follow the standards that are promulgated by FASB when I prepare my financial statements and issue those to the public for making investment and credit decisions. Now, the reliability that is offered to those financial statements comes from an independent auditor. For example, I'm a CPA. I have a license to audit companies to see that indeed they did follow the standards when they issued their financial statements. So investors and creditors get an additional amount of assurance with financial information because they're able to see that auditor's report, and they're able to see that indeed the company did follow the standards when they prepare those financial statements. Now, we said that standards are important because the companies follow the standards are important because it allows me to compare two different companies. If I'm trying to decide if I want to invest in Apple or Microsoft, let's say, well, since they both use the same accounting standards, I can sit there and compare Microsoft to Apple, Chevron to, Shell, whatever companies I'm looking at and trying to decide whether or not I want to invest with them. I can compare those by looking. I can decide by looking at and being able to compare their financial statements because they all follow the same standards. Now, when we talk about financial statements, we have these that are listed that you see on the screen. So what happens is the FASB. Okay, so that's kind of what we talked about last time. The FASB is the entity that creates generally accepted accounting principles, the FASB, and the financial statements are then prepared by the companies. And they follow those standards to prepare these financial statements. One is called a balance sheet. The other is called the income statement. The other is called the statement of stockholders' equity. Another one is called the statement of cash flows. And then we have note disclosure, and these are often referred to as footnotes. And what these footnotes do is they expand and elaborate on the information that is in these financial statements. Now, in this class, in the beginning, we're going to spend quite a bit of time with the balance sheet and the income statement. Statement of stockholders' equity, the main thing we're going to focus on is something called the statement of retained earnings. By the way, guys, I understand that my writing on the screen here is pretty hard to read, and so I will always call out to you what it is I'm writing. So sometimes rather than trying to read it off the screen, just sort of listen to what I'm saying. It is the statement of retained earnings part of the statement of stockholders' equity that we'll focus on here in the beginning of the class. We'll get to the rest of what's on that statement towards the brown. Well, really, you'll spend more time with that when you get into 1B. And then a statement of cash flows you'll get to in another class. So we're going to spend most of our time with the balance sheet, income statement, statement of retained earnings in 1A, and then you start spending more time with some of these other statements as you move through the 1A, 1B, 1C sequence of classes here. Okay. Any question on that so far? Okay, good. So we have these statements. The FASB issues the standards. Companies are to follow those standards when they prepare the financial statements, and an auditor comes in, and the auditor will give an opinion on those financial statements. Sometimes it's called a report on those financial statements. The CPA comes in, gives an opinion. Investors and creditors take these statements and they look at them, and that's how they will make their decisions to whether they want to lend some money, they want to buy a company stock, etc. If you buy company stock, you'd be considered an investor. If you are lending a company money, you'd be considered a creditor. Okay. Now, sometimes students will say to me, well, which of these statements is the most important? And that's like trying to ask an accountant to choose amongst their children. Okay. All of these statements have their own set of information that is key to making those investment and credit decisions. Having said that, I don't know that this statement of stockholders' equity is maybe as important as a balance sheet, income statement, and statement of cash flows, okay? But all of these statements are important for making those investment and credit decisions. Okay, now, when we put information in those financial statements, we have some measurement principles that we need to follow, okay? And you can see here we have historical costs, okay? What does the historical cost principle say? Historical cost principle says for fixed assets, those are big things, okay? Like land, buildings, equipment, vehicles. For fixed assets, we are to carry those on our financial statements at historical cost. Historical cost says, what did you pay for that item at the time that you acquired it? That's historical cost. What did you pay for this at the time that you acquired it? So let's say we bought a piece of land somewhere here in the Bay Area. okay, in the South Bay, whatever. We buy a piece of land in 1974, and let's say we paid $100,000 for this nice piece of land, okay? That same piece of land today, it wouldn't be a shock if that was worth what? 1.1 million, let's say, right? With the way that, prices of property have gone up in the Bay Area over the last, 50 years or so, right? So we bought it back in 74. It's, 100,000 we paid for it back then. Now it's worth 1.1 million. Well, on the company's financial statements, they would list that piece of property at a cost of 100,000 because that's what they paid for it. That's what the historical cost principle says. Now you look at that and you say, well, wow, there's somewhat of a distortion there. Then we're saying it's only 100,000. Meanwhile, it's worth 1.1. Well, remember the creation of the SEC and the FASB came in 1934, just after the Great Depression, and the crash of the stock market is seen as a significant part of what ushered that in. And part of what caused the crash of the stock market is that companies were going in and putting in subjective information in their financial reports, and it turned out that when some of that stuff wasn't true, then investors lost confidence in the market, and that caused the crash. So what the SEC and the FASB then decided is, hey, we need some conservatism here. So we're going to keep things like fixed assets, what you pay for a piece of land, because of the subjectivity associated with appraising that, what's the value of that. We're going to make you carry it at whatever it was you paid for it, even if that was 50 years ago, so that we have the most reliable set of information, because there was an arm's length transaction there. You sat there and you paid that for that land. So that's the value that you will show on the financial reports. Okay, that's the case for fixed assets. Now, sometimes students will say, oh, I don't like that rule. That's, that doesn't seem right. Well, you're not alone. For example, under international financial reporting standards, okay, if you were a company, say, that was listed in the I think the stock exchange for the United Arab Emirates is in Dubai, I believe. Okay, so if you were a company that was listing on the Dubai exchange, okay, what would happen? You would have to have your financial statements there, but you would be able to carry that piece of land at 2.1 million, because the international standards don't really have that conservatism that we see in the US, in the Chinese standards. I think even European standards, I believe, I probably shouldn't because I haven't looked that up, but I know that the Chinese standards, the US standards, I know for sure, will require that you carry that at historical cost. And the reason being that it's sort of in our consciousness, it almost becomes a psychology, a social thing more than anything, that we don't want to write up our fixed assets above what the historical cost was. Question on that? Okay, now you see on here we also have fair value principle. And what the fair value principle says is, look, there are some items that we will carry at their fair value. What is their value at the end of the reporting period, typically the end of the year? What is the value of December 31st? That's the value that we're going to assign to those items in our financial statements. Now, if we're talking about things in which there is an objective measure of their value, then FASB says, yeah, carry those at fair value. And the classic example is if we have an investment in stock. Okay, so I'm a company, I've made an investment in stock of another company. So I'm John Company, I invest in Apple stock. I have that investment that I'm holding. That investment I could carry at fair value. Why? Because everybody agrees as to the value of that item at the end of the year. Everyone agrees, and I don't know what the amount is, but that Apple stock is trading for $200 per share, let's say. I'm just making that number up, but whatever it is, that stock is trading for that amount per share, at December 31st, the bell rings at the end of the year. They ring the stock market bell, New York Stock Exchange. You've seen them up there ringing that bell. Everybody agrees that that's the value of that stock. Okay, so that one, I would take the number of shares, say I have 10 shares, and I'd multiply that by the amount per share that it's trading at, say $200, and I would list that stock at $2,000 on my balance sheet, even though maybe I paid, way back when, I only paid $20 per share, $5 per share for that stock. I would be able to mark that to market at the end of the year. Now, of course, if the value goes down, then I would have to write that down. So I take holding gains and losses when I'm holding a security such as stock that is traded because there's an objective measure as to the value of that stock. Question. Okay, so when we talk about historical cost principle, we talk about fair value principle.
Professor?
Yeah.
I'm a little confused. So the fair value, it's only what it's worth at the end of a certain time.
Yeah, in other words, companies prepare their financial statements, and typically they will probably let me say it that way. They may prepare quarterly statements. So they'll have one at March 31st, June 30th, September 30th. And then all companies prepare year-end statements at December 31st. And so just let's focus on the December 31st, okay? Because that would, at the December 31st, that would be the full 12 months of information at that point in time. So at December 31st, you'd look to see what the value of the stock was. And when you prepare your balance sheet, you would show that investment, whatever I said, at $2,000.
Okay.
Does that make sense?
Yes.
Okay.
Thank you.
Okay, good. Okay, good. Now we come over, and again, guys, if there are questions, just jump in with them. I know it's kind of hard sometimes to unmute your mic in time. So if I flip to the next slide and you're still, wait a minute, we can always go back, okay? So just jump in when you have a question. We also have a couple of key assumptions, okay? We have the monetary unit assumption, and what the monetary unit assumption says is, look, we don't want you, coming from FASB saying, we don't want you putting a bunch of subjective commentary in these financial statements. We don't want you to say land ready for sale. Or we don't want you to say land that will sell quickly, okay? You just say land, you say $100,000. We don't want you saying land that is really valued much less than what we could sell it for. No, it's monetary unit assumption. We're going to be reporting amounts in dollar amounts, not in, qualitative characteristics that we're giving about the items that we're including in the financial statements, okay? Economic entity assumption. What the economic entity assumption says is that a company should not commingle the information about the owners with the information about the company. Okay, so let's just use an example there to understand the economic entity assumption. Let's say you can see the different forms of business that we talked about last time. Let's say I'm a sole proprietorship. I'm a barbershop, okay? I have a barbershop, that's my business. And in my barbershop, let's say I have, 4 barber chairs where I, service the customers, give them haircuts, cut their hair, whatever it is I'm doing, right? Okay, so I have those 4 barber chairs inside my barber shop, but at home, because I'm a barber enthusiast, okay, I have an antique barber chair that I keep in my parlor there. And, when people come over to visit my house, we have a good time that people get to sit in the chair, they get to lay back in the chair, and I don't know, I pour, shots down their throat or something while they're sitting in that barber chair. Okay, so I'm having fun with that chair at home. The 4 barber chairs that are in my business, should those be on my barbershop's financial statements? Should I report those as assets on my barbershop's financial statements, the 4 that are in the store?
Yes.
Yes.
Yes, because I'm using those productively in my business. Okay, good. How about the one that's at home that I'm having my little parties with?
You shouldn't.
No.
I would not include that. Good. Okay. I would not include that because I'm not using that in my business. So I don't bring in, well, geez, I have a barber shop. I have a house. Let me put that on the financial statements of the company. No, you keep those separate. Okay. Now, let's say one day I have a moment of clarity, all this partying I'm doing, and I just wake up one morning, I say, you know, I've been wasting my time. I'm going to take that, you know, that antique barber chair, and I'm going to put it in my barber shop. And what I'm going to do is I'm going to advertise, hey, come have your hair done in this antique barber chair. That's going to attract additional business. And in fact, instead of charging, what do they charge for a haircut these days, guys? I don't know. I'm serious. What do they charge? $20 for a haircut? I'm not sure. Back when I had to worry about such things, there was only $5. So I don't know what it is now. Okay, but instead of charging, you know, $50, whatever, I'm going to charge $80 for a haircut when you sit in the antique barber chair. Okay, should that barber chair now be included in the financial reporting of my company?
Yes.
I had it at home. I took it out of my home and I put it in my business and I'm using it. It's generating revenue for me now. Should I include that on my financial statements of the company?
Yes.
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 Yes, I should. I will bring it on. Good, very good. I will bring it on. And by the way, I bring it on at whatever the value it is at the time that I bring it into the business. So even though I maybe paid $100 for it back in 74, let's say, in 2023, 73, I paid, you know, $100 for it, let's say. And then what was it, 50 years later? The thing is now worth $10,000. Well, I would list it on my financial reports of my company at $10,000 because that's the value of it at the time that I bring it in. Question.
Would the barbershop and the chairs be considered capital?
Would it be considered capital? Please define what you mean by capital.
Like land, labor, and that stuff. Would that be considered capital?
Oh, you mean like economic capital?
Yeah.
From the standpoint, yeah. The factors of production are labor, and I'm getting into my economics here without having prepared for that. Land, and what's the third one? Money, I guess, is the third one. I'm not sure. But when they say land in economics, they mean things like, you know, equipment as well. Does that answer?
So like any equipment that a business would use would be the assumption part of the equipment. I don't really understand. Is it the discrepancy of like whether you're using it inside your business or not?
Well, here's the balance sheet of the barber shop. And on there, I would probably have this level of specifics, but I would say 4 barber chairs. And let's say there's a $400 that I paid. I paid $100 each for those. Okay. But then I have the antique chair at my house. Okay, so that's the antique chair at my house. And let's say I paid, you know, I'll say I paid $200 for that since it's an antique chair back in 1973, let's say. Okay. Then what happens? Then I take the barber chair out of my house and I bring it to my business. So I have the 4 original chairs that I described, and then I have this really cool antique chair that I bring in to the business. Well, now when I prepare the balance sheet, when I prepared the balance sheet at first, it was just for the 4 chairs, right? Okay, but now since I brought in this new chair, my antique chair, now I have what? Now I have 5 barber chairs that I report. Okay, 5 barber chairs. And let's say the antique chairs, I said, had a value of $200 when I bought it, but now it's worth $10,000. So I would have to put what, $10,400, the 4 chairs that I had originally at $100 each, plus the $10,000 value that I brought in for the antique chair. And that would be reported on my balance sheet. And now companies would look at that and they would say, I mean, not companies, but investors would look at that and say, oh, okay, gee, he's got this asset in here that he's going to be using productively in the business, whatever. Or if it's an economic analysis that they want to do, they can do that. They can start to make any kind of decisions that they want to based on what I'm reporting on the financial statements. So in this class, we're focusing on what goes in to these reports as opposed to, and we can talk about how investors might look at this information, but we're not really learning how to make investment and credit decisions. We're learning about the information and how that information will be getting into these financial statements.
Okay, I see. Thank
Okay.
you.
Anything else?
Yeah, hi. I do have a question. Normally, when we paid for the businesses, we can claim for expenses, right? But for this chair, initially we paid $200. Now value of this chair is now 10,000. So where the difference go?
Well, couple things. I have to back up. You said that when we pay for the chair, we can charge it as expenses, and that's not correct because expenses have a very specific definition. Okay, an expense means that I've spent money and there's no future economic benefit associated with that expense, with that payment. Okay, whereas if I pay something for an asset that is going to last over time, that's not an expense. Okay, but we'll get more into that later, but I just want to keep us on the righteous path here, okay, as we go along. But excuse me, guys. But for the 4 chairs, I paid $100, right? So let's say, just for discussion's sake, I had $10,400 cash sitting in my company's bank account. Okay, so the company has $10,400 cash sitting in the company's bank account. If I'm a corporation, it's in the corporate bank account, right? What do? I took that $400 out of that account and I bought the chairs, let's say, okay, the 4 normal chairs, not the antique chairs. So at that point, what would happen if I was looking at my balance sheet? Okay, and I'm not going to bind myself into a smaller space here. Okay, if I look at my balance sheet over here, okay, I'd have cash of 10,000 and I'd have chairs of 400, right? That's for those 4 chairs. Okay, and then again, I have that moment of clarity. I bring the antique chair in. I had bought it with my personal funds some years back for 200, but now it's worth 10,000. So what do? I now show for the chairs what, 10,400, and I write a check out of the business account and I deposit it in John's personal account. The chair is gone. And, I don't know, let's say I'm paranoid about the banking system or something. I take that $10,000 and I put that under my pillow. So the cash that I have under my pillow isn't in the business anymore. So I don't report it as a business asset. And instead of showing 10,000 cash, I show $10,000 worth of barber chair.
Thank you. That answered my question.
Okay, good. Okay, good question. Anything else, guys? Now you look at that and you say, well, John, this sounds like, you ever see in comedy movies, the guy gets pulled over by the sheriff in a small town somewhere. And the guy says, well, I wasn't speeding. I want to go see the judge. And then, they say, well, okay, come to the courthouse. They go to the courthouse and the sheriff takes off the sheriff hat and puts on the judge robe, you kind of get a feeling with something like that. Well, what's going on here, Well, remember that when somebody's picking up these financial statements, maybe a bank, and they're thinking about lending me some money, and they're going to lend me some money, they're going to want to know that there's some sort of value associated with this company. And they look and they say, barber chair, 10,400, eh? Okay, so that seems like an awful lot for a barber chair. So what happened? The company would have to have an audit, and you'd have to convince the auditor, the CPA, somebody like me, that indeed that chair does have a value of $10,000 at the time you brought it into the company. Okay, so I'm a CPA. I'm not a barber chair expert. I'm not a furniture expert. So in circumstances like that, what CPAs often will do is they will engage a specialist, and the specialist will give the CPA some assurance that indeed things like, I was on the audit of the U.S. Forest Service, and the Forest Service values, the Forest Service reports its asset as the forest. And the way they figure out the value of that asset is they figure out how many board feet of lumber are in a forest. So we did a few different forests. One was El Dorado National Forest. It's a beautiful area up there. We did Tahoe National Forest, and it's a nice audit site because you're in a forest, and you say, well, let's see the inventory, and you look out the window, there it is. Well, how do I know how many board feet of lumber are in the forest? I should probably back up and remind you, I work for the federal government, an agency called the Government Accountability Office. GAO was responsible for auditing the Forest Service financial statements, and I got put on that assignment fairly early on in my career. I'm talking like years before you were born, before maybe your parents were born, I don't know, in the late 1980s. So anyway, I get put on that assignment, and I'm looking at the Forest Service, and they articulate how many board feet of lumber. Well, we don't know how many board feet of lumber, so we had to have a silviculturist. This is a person that can look at the general health condition of the trees. They're not accountants. They're people that understand trees and the health of the trees and the size of the trees, and can tell you how many board feet of lumber are in a tree. And they do some amount of sampling and whatnot, sampling and whatnot. And then they are able to say, yeah, that seems like a reasonable estimate as to the board feet of lumber. I can rely on that, and now I can issue my opinion. Of course, there's other things that you would look at it because, they have accounts receivable, they have bills, all that. You look at, do some other procedures around those other things. But for that particular thing, I use a specialist. And when I issue my opinion on the financial statements, I'll say, yes, the financial statements were prepared in accordance with the appropriate accounting principles. And the users of those statements may not even know that I had to call in that specialist. I don't have to say I used a specialist and I did this, that, and the other. They know because I have that license. They know that there's reliability associated with the words that I put down on the page. they call auditors because back in a lot of the accounting profession comes from England, okay? And back in the 1800s and whatnot, a lot of people couldn't read. And, look at when you watch Christmas Carol, Dickens, it's around that time when the CPA profession, in fact, Scrooge's business was a CPA business, even though they don't call it out as such. That's what he was doing. Okay, that's the kind of stuff that he was doing. And they called it his counting house. Okay. And in that time, if you ever, you see the cartoon about A Christmas Carol and all that, but if you read the book, you get a much different feel for what was going on around Scrooge at that time. And there is a high level of illiteracy. This idea of being able to read is fairly new. I mean, it's, more into the 1900s, and probably, the 1910s, 20s, when people really started, having, a lot of people knowing how to read and stuff. In fact, my dad tells the story that his grandmother used to criticize her sister because she couldn't read. And my dad's dad would tell my dad's grandmother, well, you can't read either. So that was kind of a funny story. And so my dad's grandparents couldn't read. Okay. So they call you auditors because you would speak out loud. You would say what your findings were. And that's how people got reliability with those financial reports and whatnot back in the 1800s. Now, so you could audibly hear what the person was saying. You call it an auditor. Okay. Now, of course, as I mentioned, thank God we have a higher level of literacy. And now I would put on the page, hey, you can rely on these financial statements. Investor and creditor looks at that and it's taken that, okay, that's great. Now, sometimes I'll have students that'll say, well, who cares? That's just a piece of paper. Okay, that's kind of like getting pulled over by the police and the police officer says, can I see your license or whatever? And you say, no, why should I give you your license? All you have is that badge sitting there. Of course, they also probably have a gun, but all you have is that badge. What's that badge? I'm not going to give you my license. What are they going to say? Step out of the car, please, right? Okay, so, even though it's a piece of paper, it's everything that's behind it. Even though it's a badge, it's everything and everyone that's behind that badge. It's just not the guy that the man or woman that the badge is pinned to. And so that carries weight with it. It means that I passed a 4-part exam. First I got a degree in accounting. I had to go to college. Then I passed a 4-part exam that's administered by the state. I got the appropriate scores. Then I had to work under the supervision of a CPA for 2 years. I had to pass an ethics exam. I got the license issued, and then every 2 years, I have to have obtained at least 80 hours of continuing professional education. So there's all that. There's the state boards that look at the CPAs to make sure that they're doing all of those things. There's something called peer review, where another CPA firm comes in and makes sure that the CPA firm that they're looking at has certain controls in place that allow them to do quality audits. They sample some of their audits to look to see that they are done. If you're a public company, there's something called the Public Company Accounting Oversight Board that will select certain companies' audit reports and look to see that those audit reports were done correctly. There's the SEC. There are disciplinary actions. There are courts if you mess up, etc. So it's just a piece of paper, but it's all that stuff that goes along with it. Now, of course, you're probably listening to all that and saying, well, why the hell do bad things keep happening then? And you're right. All of those things that I just talked about are a prayer, are a hope, are a way of saying, please, God, don't let anything bad happen. Okay. I mean, you go to the courts and there's a big statue of somebody sitting there with a blindfold and, you know, holding a scale and all that, and you think, wow, how could anything possibly go wrong here? Yet it does. So all of those things are what? A prayer that something won't go wrong, but of course we all know that they do. Okay, so when, you know, I see politicians stand up and they say, well, we're going to put this in place, this law in place, so this never happens again. I'm like, oh God, don't say that, because that means it's going to happen again, right? So things do happen, but we do have all of this in place to try to avoid some of that. Okay, okay, good. Any questions, guys? Okay, let's go ahead then, and that's probably a decent transition. Because I was just mentioning some of these entities. The one that you see here is this Public Company Accounting Oversight Board. And the PCAOB was a creation of the Sarbanes-Oxley legislation. Why Sarbanes-Oxley? Why that name? Sarbanes was the senator, Democrat. Oxley was the House member, Republican. And they got together after some financial scandals, like Enron is one you probably hear about a lot. WorldCom was another big one that you probably hear about a lot. They come up from time to time. And what happened was back in 2002, Congress basically got tired of these problems coming up and said, okay, we're going to put an act in place called Sarbanes-Oxley, and it's going to have, and the real teeth of Sarbanes is that they're going to impose criminal penalties. Not, it could be civil penalty too. Civil penalty means they're going to charge you a fine. Okay, so if you get a fine, that's a civil penalty. Criminal penalty means you're going to jail if you're found guilty, right? Okay, so we're going to put criminal penalties in place. Okay, for CEOs, chief executive officers, chief financial officers, accountants who engage in financial reporting fraud. Okay, and those penalties are quite severe. Okay, the other thing that Sarbanes does that's probably more relevant to this class is it requires that companies have, and we put here this ICFR, internal control financial reporting. Okay, so what happens is not only is there an opinion that says, yes, you can rely on the financial statements, but the CPA and the company are also required to issue an opinion that says we have good internal controls. And internal controls, which we get more into, I think it's chapter 6, but what internal controls are supposed to do is they're supposed to ensure reliability in the financial reporting. So, for example, let's say you're a company and you have cash and you want to safeguard that cash. How would you safeguard it? That's a question to the class. How would you make sure that people aren't stealing the cash?
Put it in a vault.
Okay, you maybe have a physical control, like a vault of some sort. Yeah, right. Or you have some locks on it, whatever. That's internal control. How about putting it in the bank? Okay, you put it in the bank, but how do you ensure that, you know, employees aren't writing themselves checks? Well, maybe you put a control in place that says if a check is in excess of $100, now it requires what? 2 signatures on that check instead of 1. Now 2 people have to be in on the fraud in order for that to work out. And, you know, you say, well, that's not that hard. Just get 2 people to agree. The problem when 2 people start to get involved in perpetrating a fraud is there's a high probability, because they're not doing the right thing, that they're going to get into what? Some kind of argument about something, and one is going to rat the other out, right? So when you have a dual signature, that often is used as an internal control so that we know that the assets are being safeguarded, that there's reliability in our financial reporting. And under Sarbanes, not only do you have these criminal penalties, but for engaging in the fraud, but also the auditor is going to be involved in looking at those internal controls and saying whether or not they think they have the ability to prevent, to ensure reliability in financial reporting. Question. Okay, good. Now you come over and ethics. Okay, and there's been some of the scandals that I've talked about on here, and they continue on. I guess, you know, the latest one now is this crypto one, the crypto company, you know, keeps happening. You know, again, put all these controls in place and bad things still happen, right? You just can't stop bad things from happening, right? Okay, but you wish you could, but there probably are a lot of things they stop, but something always seems to happen anyway. Okay, so what happens? What we have on these couple slides, guys, are ways to handle an ethical dilemma. And, you know, I could sit here all day and read these to you, but let's just have a little conversation here. Has anyone here ever faced an ethical dilemma? And don't give me, you know, a moment of personal indiscretion. That's not what I'm talking about. You know, don't tell me a story about how, you know, your roommate's friend asked you out and you went or something, you know. Don't tell me that. You know, I want, you know, something that you can share with the group here where you had an ethical dilemma where you're like, should I do this or not? Yeah, nobody ever wants to share one. So I'll tell you the ethical dilemma that I had in practice, which was, again, auditing the Forest Service. And I was assigned to look at the cost accounting system. So what the cost accounting system does is it gathers all the costs that the federal government puts in to developing and maintaining forest land. And they put those costs into a cost pool. And then over the years, they go ahead and they report a depletion of that pool. So as that forest is used up, of course, more costs are going into the pool, but as the forest is used up, and you say, how do you use up a forest? Well, they harvest the timber. They basically harvest the timber. Most of the timber and whatnot that you see come from federally managed lands. Okay, so these federally managed lands, they, you know, control. They just, because what was happening, you know, back in the 1800s is, you know, people would just come see a bunch of trees and just cut them all down. They would just clear cut this whole area and destroy this natural resource, right? So we created the federal government came in and said, okay, we're going to create the Forest Service to control this, right? And so, you know, they have a whole process where a lumberjack comes in and bids on a parcel. Okay, they have several, and the way they do the bidding, there's a box there, and all the bids go into the box, and then they open up the bids, and whoever bids the highest for that parcel is the one that wins that, and then they go and they harvest that parcel. And you've probably seen these big trucks with the logs. Well, those are going off to, you know, create wood to build houses and all that. Okay, so the federal government manages all that, and what they do is they put all the costs associated, all the salaries they pay and whatnot, and they put that into the pool for the costs that will then be depleted over time. Well, when I looked at the items that they were putting into that pool, some of them include amounts that they were spending on things like roads. Well, let me back up. The years that they depleted that over was 100 years. They were saying, hey, it takes 100 years from the time that we plant a sapling to where there's a tree that's going to be, you know, able to be cut down and used for wood, whatever, right? Okay, so when I looked at some of the costs they were putting in there, they were also including the cost of roads, drainage systems, these kinds of things. Do roads last 100 years? Does a road last 100 years? You spend money, you build a road, and you don't have to do anything to it for 100 years?
No.
No, drainage systems don't last 100 years. There were certain items that they were putting in there that were being depleted at too slow a rate. My point was that they needed to create what various cost pools and have various time periods that they would allocate those costs over to get a more accurate picture as to the speed to which that natural resource was being depleted. Well, Forest Service, the folks I was working with, look at me and they say, "Hey, kid," I was fairly new in my career at that point in time. "Hey, kid, you can't tell us that because the GAO, Government Accountability Office, where I work, the GAO team that was in here 3 years ago when we developed this system didn't say anything. Why are you saying this now?" So I'm like, I don't know. I don't know why they didn't say anything. You know, they're challenging not me, they're challenging the agency, right? So I go and I tell my boss, "Hey, we've got a question here. How do we want to handle this?" My boss looks at me like, "I don't know." So he says, "I'll get back to you." So I guess the question keeps going up the chain. My boss calls me in his office. I'm like, "Oh, I guess I'm fired." And I said, "Yeah, what's going on?" He says, "Guess what? We have to brief the Comptroller General on your question, and we're going to have to do that in the next couple of days." I'm like, "What?" Okay, the Comptroller General is the head of the GAO. Okay, now it's a 15-year appointment to that position. President nominates, Senate confirms. Okay, 15 years. That's a long term. Okay, what happens? President gets what? 4 years, maybe 8. Okay, sometimes some presidents you want 4, some you want for 8, whatever. Okay, senators are what, 6 years? House members, the reason they act so crazy is they got to run every 2 years, right? So House members are 2 years. This is a 15-year appointment. And I'm here to tell you that you don't walk in the first day and they say, "Congratulations, you're the Comptroller General." So you'd have to have been around for a while. So you're probably going to retire out of that position. Okay. Why such a long term, do you think? Supreme Court is for life, isn't it? Or until a person decides to quit. Why do you think such a long term? What do long terms in political office and in office service of office federal positions, why such a long term? I'll wait.
I'm not sure.
You're not sure why long term? Okay.
Is it like a greater responsibility?
Okay. Let me ask it to you this way. Let's say I tell you, "Hey, you got a job for life. There's no way you can get fired from this job." Okay. How comfortable would you be in making decisions about how you execute that job? I tell you, you got a job for life. You won't get fired. How comfortable would you be now? I mean, some people probably think, "Well, I wouldn't even go to work." Okay, but assuming you're going to responsibly execute your position, how comfortable would you be when you had to make a decision about something?
Super comfortable.
Right.
Like so much confidence. Yeah.
Right. Okay. So it does what? Something like a long appointment, 15 years, right, is designed to make you independent, to make you comfortable in the decisions that you have to make. And if you're the auditing arm of Congress, you want a position where the person is very confident in the decisions that they have to make. And that gives more reliability to the reporting, to the findings of in this case, the GAO. I'm of the opinion, and I'm not objective because I worked there for 26 years, that the GAO is the most independent audit organization ever. Okay. And hey, look, I worked there 26 years and, it's like a marriage. You see the warts and whatnot, but you also see the many good things. about an entity that you've had that long a relationship with. And I believe that GAO is a very independent audit organization. So we have to brief the Comptroller General, 15-year appointed term for that individual, nominated by the president, confirmed by the Senate. And so we brief him, and I've got all this information and evidence that I'm going to share with them in the meeting and whatnot. And we get 5 minutes into what I'm explaining, and he says, stop. Tell the Forest Service that was then and this is now. I don't care what we said before. What you are saying is a legitimate accounting issue. Tell them that that's what we're going to report. Okay, so we reported that. And in the report, we talked about the problems that they have with their cost accounting system. They rebutted that and said, well, GAO didn't say anything 3 years ago. Now they're saying this. So we took a little bit of a hit as to how we're being consistent. But what would have been the alternative? The alternative would have been for me to say, no, okay, all right, we won't say anything more since we said that 3 years ago. I move on. Under the Freedom of Information Act, what could happen is somebody could discover that we knew about this problem, didn't report it. Now we've got what? Now we've got all the kind of scandalous kind of things that you hear about, right? That's what you always hear. Well, they knew and they didn't do anything and they didn't follow the procedure, et cetera, et cetera. Okay. So the moral of the story is under the umbrella of ethics is what? Disclose, disclose, disclose. If you're sitting there and you already have that instinct, okay, you don't have to work on that instinct, you already have it. If you're sitting there and you're like, something just doesn't seem right here, I don't have the information in my brain to know what is the right ethical thing to do at this point in time, then go up the ladder. You don't have to sit there by yourself and try to figure it out. Go up the ladder. Talk to your supervisor. Say, this is what's going on. What should we do? And the response that they give you, you don't have to accept that either. Okay. If they say, well, don't worry about it, no, there needs to be some kind of a, rationale behind that satisfies you. Okay. If you're not comfortable with that, you continue to push until you get to what, or you're satisfied as an ethical resolution of whatever it is you're looking at. Okay. So that's the main thing. I mean, they always have these steps. First do this, then do that. Your instincts are the most important piece of that. Okay. All right, good. Now you come over and you take a look at these potential careers. Guys, do you need a break? I'll tell you what, let's do this slide and then we'll take a break. How about that? Okay. Or do you just want to keep going and get out early? What do you want to do?
Can we keep going and get out early?
Do I have a second on that?
Yeah, that sounds fine.
Yeah, that sounds fine too.
Say aye. Okay. Okay, so we can't do the show of hands, so that's fine, guys. We'll go ahead. So we'll go to, how about this? We'll go to 11 o'clock. Does that sound good? And we'll get out a little early here.
That's fine.
Yes,
If you need to talk to me, don't forget, guys. Oh shoot, I got to give you the link to the office hour. So I'll put that up on Canvas. And so if you need to meet with me, remember the office hour is just after this class today, from 11:30 to 1, and I'll put a link up and we'll get out at 11. Okay. Okay, good. So careers. I don't know. Are most of you planning a career in accounting? Are you in this class because you've selected accounting as your career, or are you thinking something else, but you have to take accounting? And not everybody has to answer, but
Yeah, it's like around the field of accounting or economics.
Okay, good. All right, well, this is useful regardless, whether you're thinking about a career in accounting or not, just to understand what maybe some of your classmates and colleagues are going to be looking at. Okay. And so one thing, one area is public accounting. Okay. Now, what public accounting is, there are 4 big accounting firms in the United States, around the world, really. They do most of the audit work around the world. One is called PwC, PricewaterhouseCoopers. Our guest speaker is a retired partner from PwC. So when we have that recording available for you, you'll get to see Danny Wallace at that point in time. The other one is KPMG, and I don't know what KPMG stands for. I don't think anybody does. There's EY, which stands for Ernst & Young, and then there's Deloitte, which stands for Deloitte. Those are the big 4 firms, but there are hundreds of public accounting firms that do the work of going in and looking at the financial statements and issuing that opinion on the financial statements, saying that they're fairly stated. Okay, you could work for the government like I did, the GAO, which in the GAO, we look at financial reports of of federal agencies and report on their accounting, like what I was describing to you with the Forest Service. You have the IRS auditor. IRS is hiring. IRS is looking for individuals to join their team. Okay, the problem with IRS is you got to have a sort of a different skin about you. I'm of the opinion. When I interviewed with the IRS when I was coming out of college, they asked me, let's say you're sitting in your cubicle and you hear your neighbor being audited in the cubicle next to you, and you hear them lying to the agent. What would you do? And I said, I wouldn't do anything. It's not my job to bring my personal life into another person's audit, etc. They didn't like that answer, so I got this pretty quickly. Thank you for your interest in the IRS, but no thanks. So, you know, you got to be a little bit different. FBI, they tell you, you know, follow in a crime, follow the money trail, and, you know, you'll get to the bottom of what's going on. Well, the FBI looks for accountants. If you combine language skills, Spanish, Vietnamese, Chinese, okay, you combine those language skills with accounting, the FBI would like to, you know, give you an opportunity. The only problem is you got to carry a weapon. You're going to be involved in involvement with criminals. You may have to consort with criminals if you're doing some sort of undercover work. You know, the good side of that, though, is you retire with a full pension at 50. And I know 50 sounds old to you, but it's not. Okay, so that's not that. That's good. That's a good benefit. We've mentioned SEC. So you have these different careers in government. I saw a statistic the other day that the average age of a federal employee is something like 47 or something like that, or maybe larger than that. That means what? There's going to be mass retirements coming in the federal government. They need you. They need people with accounting skills, financial skills, information system skills. So I'm telling you, plan to work for the government at some point in time, because it's probably going to be a pretty nice career for you. Okay. Forensic accounting. What forensic accounting does is, let's say there's a crime and they want to figure out where the money went. Okay. Well, you know, if you're doing work, say, for the FBI, probably you'd get into some level of forensic accounting. But there's not only that. Let's say somebody dies without a will, and now there has to be a process to figure out who gets what. Forensic accountant would probably come in and do some of that work. Okay. Private accounting, those are the people that work for, say, Apple. They're involved in what? Involved in helping them to issue their financial statements. So all of these are different opportunities. We don't even mention the not-for-profit sector here. There's a lot. Accounting can take you into many, many different avenues, directions. Public accounting is nice because today, you know, you're sitting here looking at I keep using Apple as an example for some reason. Today you're looking at Apple, tomorrow you're looking at a 7-Eleven. So you get a broad spectrum of business, and what tends to happen is after a couple then you start to specialize in an industry, and then you go to work in that industry. And I've had some friends that, colleagues, former students and stuff that I, associate with, and I will go to dinner with them or something, and they'll be telling me about just these really interesting, technological developments and stuff. And they're almost speaking as experts in the field because they've gotten through an audit with one of these organizations. So anyway, okay, let's go ahead and one more thing about the FASB, which is the cost benefit consideration. Okay, and what the cost constraint says is that when FASB is sitting there, I mentioned it's a 7-member board, right? And they pass a new standard by a 4-3 majority, simple majority. Okay, did I mention that FASB is a 7-member board? Anyway, it's a 7-member board. They pass a new standard by a simple majority, 4-3. Okay, that's why they have an odd number. And when they're making their decisions about whether they're going to pass the standard, they say, is the cost to a company to provide this information, okay, is it more than the benefit that we believe the users, the investors and creditors, will get out of that information? And if the answer to that question, the cost is more, if the answer to that question is yes, or the benefit isn't greater, right, then what they'll do is they will make a decision not to issue that standard. Okay, and whoever did this graphic, I think, meant to do it the other way, because to me, they should have the benefit as the heavy side, so that should be lower, right? And if the weight on the benefit side is heavier, right, then they're going to go ahead and they will require companies to provide that information. If the cost is more, then am I saying that right? Yeah, the benefit should be more. Okay, if the cost is more, which means the cost will be down like it is in this picture, then they would not require companies to put that. Question. I didn't articulate that as well as I would like, but I think you get the point. Okay, that picture is a little confusing because it makes it look like, well, you shouldn't do this. If this is the case, don't issue the standard. Okay. All right, good. So we have the FASB. They look at the different cost benefits. What are the needs of the users? They issue generally accepted accounting principles. And then companies are to follow those to prepare these financial statements. Okay. So let's just go ahead and they say the accounting profession. It's the FASB that does that, right? And creates the accounting standards, and then the companies follow them, and they prepare these financial statements. Okay, and the first one we're going to look at is the income statement. Now, why do they call it the income statement? Because it reports what?
Income.
So we call it the income statement. Okay. How do you calculate net income? Net income is revenue minus expenses. Okay. It's the difference between your revenue and your expenses. So on the income statement, okay, on the income statement, because we report net income on the income statement, we report what? We report revenue and we report expenses. Revenue minus expenses equals net income. Question.
Yeah, so earlier you said that an expense was something that could not give you a future profit, but wouldn't advertising could it possibly bring in more income or revenue?
That's a good question. And answer is theoretically it could, but do you know that it will?
Okay.
So what FASB says is if you don't know that something has future economic benefit, treat it as an expense. Okay, so let's say I'm not saying I do, let's pretend I do advertising for my store, and I do it around holiday time. Now, my intent is that people will come in and do their holiday shopping before the end of the year, and I'll show a nice net income for that year, right? That's why I spent that advertising. But some people are gonna turn the radio off when they hear that ad. Some people will say, well, gee, I already got a gift for my favorite person. But you know what? I'll bet you that stuff's going to go on sale early next year, and I'll get it for Valentine's Day for that person, let's say, right? So in some cases, it's going to have immediate benefit. In some cases, it's not going to have any benefit at all. And in some cases, like you're considering here, you're contemplating here, it will have benefit in the future. So FASB says if you don't know what the outcome is of an expenditure, not an expense, but a payment for something, then you should treat it as an expense. It has no future economic benefit. The future economic benefit has expired. Expense expired. I'm saying it funky like that on purpose. So if it's reported as an expense, that means the future economic benefit has expired. Okay. Now, if I buy a piece of equipment that I'm estimating is going to be around for 5 years, well, that clearly has future economic benefit. I will report that on the balance sheet as an asset. And we're going to look at the balance sheet in a minute. I'll report that on the balance sheet as an asset because now that has future economic benefit, right? Like those barber chairs, for example, another example. Okay, now, how about research and development? What do you think? Should a company report money they spend on research and development on the balance sheet or on the income statement? As an
The
expense?
income statement.
Balance sheet, because it gives the future value. We can be benefited in future. Okay,
good. One thing about accounting, sometimes you might say something and I'll say, okay, yeah, it could be that. But a lot of times about accounting, it's like, no, okay. And this one is reported on the income statement. It is an expense because FASB looks at research and development and they say, most of the time, it doesn't turn out. And since you don't know whether or not this research and development is going to come to fruition into a viable product at some point in time, since you don't know, under the rule of conservatism, remember guys, FASB, SEC, and then later FASB is a creation out of the stock market crash, out of the Great Depression. It's psychology to a certain extent, some of the things that they decide here, right? And so they turn around and they say, no, expense any money you spend on research and development. Okay, now you're looking at that, Shalini, and you were saying that, I don't like that.
Yes, I
right?
said balance sheet.
Yeah. Okay. And you're saying, I don't like that rule that we have to report it as an expense on the income statement, right? Well, then you like IFRS because under the International Financial Reporting Standards, they say that you should expense the research, just like US GAAP. But when you get into what is a development stage, you can put the development, you should report it on the balance sheet. You should capitalize it as an asset on the balance sheet. So a lot of times, guys, with accounting, it's, well, what are they telling me I have to do? And that's what I do. And they have certain reasonings and whatnot as to why, but we're sort of on the receiving end of that. We just got to follow the rules, right? Okay, okay, good.
I'm sorry, I have another question. Normally, it's income statement is time basis, like a yearly statement, right? But if the research and development is more than a year, how we
how we explain the expenses that this is incurred only on 1 year?
You take an expense in the period it's incurred. So if in year one, I spend $500 on research and development, I report that an expense in the year that I incurred that expense. Year two, on the same project, I spend $300. Then in year two, I'll report that as an expense on my year two income statement. So the income statement covers a period, okay, from, for example, this one you say is for the month ended September 30th. So this is 1 month's worth of information. Most financial reports that you probably will look at cover, the income statement covers 12 months from January 1st to December 31st. So any money that is, any transactions, I shouldn't say money, any transactions that occur within that 12-month period would be shown on that period's income statement, assuming it's not something that needs to be reported on the balance sheet because it has future economic benefit.
Okay, thank you.
Does that answer your question?
Yes, thanks.
It's a little hard when I can't see your eyes. When I train new instructors, I always tell them that if your class is looking at you like a spaceship landed, that's not a good thing. Okay, you don't want them looking at you in awe like this. You want them looking at you like this. Oh, okay, I got you. So please, chime in. If you don't understand, just tell me. I don't get that, and I'll try to explain it some more. Okay. All right. I'll tell you what, guys, because I can't do justice to this part of the discussion in the time that we have left, I'm going to go ahead and end right here. Before I do, though, before you log off, I need to do a administrative step here. So give me 1 second. And then we're going to go ahead and adjourn, but just stay on for a second here, guys. Okay. All right, guys. So we're going to go ahead and adjourn for today. Make sure, and if you need to talk to me about anything, I'll be on my office hour, and I'll put the office hour link up on Canvas here right now. After we log off, I'll do that. It'll be a different link. It won't be the same link. I will see you on Tuesday. Right now, I don't see that there is a big need to rush into the homework or anything like that. So just kind of have a good weekend. Monday is Martin Luther King holiday, so don't forget to think about the sacrifices of Martin Luther King, the civil rights movement, those that contributed to that. You look around the diversity of what you see on campus, what you'll see in the working world. Those are things that came through great sacrifice. Okay, so let's take some time to think about that, and then I'll see you on Tuesday. Okay. Okay, guys. Have a good rest of the day.
Thank you, Professor.
Thank you.
Thank you.
Bye-bye. Let me stop the recording. Okay.